Okay, so the title of this talk is How to Make Money Using Trading Systems. At the very beginning I have to disappoint you a bit because it's not about how to make money, it's more how not to lose money. I'm sorry if you try to find the holy grail here, it's not.
Okay, I leave.
Everybody can leave. So the point is here, I will try to make clear what you have to avoid and where the pitfalls are. This is from my experience and also what I learned through reading and these various years of experience. What I found, what you should not do. And if you control your risk, that's the bottom line, let's say, and if you try to avoid losses, then at least there's something already. Good. So I imagine most of you know what trading systems are. Still, here's a small introduction. What is a trading system? It's, let's say, an autonomous system which decides upon itself, upon the data, and it's a computer which says when to buy and when to sell securities. It's not human. It's just a mechanical trading system. It's a software. It's a computer which is fast and which can compute a lot of data. So, why trading systems? So, you probably have heard that more than 50% of the stocks which are traded are actually traded, at least in the United States, are traded by mechanical systems, by computers. And why do people use systems? Maybe you can tell me, or do you have an idea why banks are using systems?
Speed.
Speed is very good, very good.
Efficiency. More efficient.
Yeah, more efficient. Yeah.
Takes the emotion.
Yes, that's a very good point. To eliminate emotion, exactly. Then speed. We had this. Also to trade longer. You can trade 24 hours in Forex. As a human, it's difficult. You need at least three persons to trade 24 hours. Then to be better, of course, to be able to compute more information. You have much more input, much more data. You can use much more data, much more information. So at the end, to improve profits, of course. What do you think about this? To predict the future, to look into the future? Do you think this is possible? Some people believe that this is possible. Well, let's say we leave it open, but I think it's very difficult to look into the future. But there's something very important which is still missing here, and I mentioned it in the introduction. Do you have an idea? I said control.
Risk management, you can control your losses.
Control your risk. Huh? So control and minimize your risk. Computers are very good in controlling risk. What is the volatility? Where is the stop loss? They can compute it much easier. They can go out immediately. You know, these kind of things. We as persons sometimes we forget these things. No? And if you control your risk, then you have 50% of your gains already done. Okay, if you look at systems, what kind of KPIs, what kind of characteristics do we have? There are many characteristics of a system, but the most important one, of course, is a profit. Then how many profitable trades or what percentage of profitable trades do we have? Here, it's very important to note that the system doesn't have to be always right. It only has to be more than 50% right. If it's 51% right and 49% wrong, that's fine. At the end of the year, we make money. Not even this. Can you imagine that a system is fine if it's only 10% right?
Yeah, to make a large profit.
If the small number of trades are making more money than the 90% of trades which are losing money. And of course the drawdown, is everybody of you aware what drawdown is? Who does not? No. Okay, I will give a small short introduction.
I think Monzo is trying to.
Yeah, I will give a small introduction. Yeah, what drawdown is. Days without new equity high is also important. So we have an equity curve, how much money we make, and if we lose money, how many days do we need until we reach the last top point? You know, it's very important this span, because the longer it is, frustrated you are in trading and the less you believe that the system works. Okay, if it's, for example, 200 days, and you have to wait 200 days until you get to the point where you reach your last maximum, it's 1 year. You will be maybe end trading before that, because you might believe that the system is not working anymore, that the market conditions change. Okay, so that's a very important point. Then also exposure, how much am I invested in the market? No? If I have a small investment always, it's reasonable that the profit is less than if I have a big investment. And so on. Then many more indicators. But these are, for me, this is one of the most important ones. Date without new equity high. But we look now at, let's have a look now at the drawdown. I explained what the drawdown is. Imagine this is our profit curve, or let's say the equity curve, how much money we have in our account. Okay? And you see, for example, the system doesn't trade here, but then it starts trading, and we make here some money, here we lose, we make money, we lose, okay? And here we start making money. Okay? Here really the system excels. It's a great system. The problem we have here is from this point until this point, we have, you see, many days without new highs. It's very frustrating. And these are the number of days without your equity high. And this here, when I'm going from here to here, or from here to here, you see? This is called drawdown, because from the last high, I'm going down, and I'm losing money. What's the maximum money I'm losing in this system? And you will see here, that's the same curve, okay? You see it here, here I'm losing money, you see? And the longer it goes, the more money I'm losing, percentage-wise. That's percentage. Okay? So you see here our drawdown curve. The drawdown curve is, let's say, a mirror of our equity curve. And similar, you see here the number of days without a new equity high. You see this, from here to here, we have here 90 days without a new high. If you're trading this system, maybe here you will say, this doesn't work. You're frustrated. Or you believe that the market conditions change, so you change the system. Yeah? And you forget that this can happen. So we have to be careful about this number of days since last equity high. Okay? I think drawdown and number of days since last equity high is clear. Okay, what kind of parameters do we have for a system? What kind of systems do we have? We have long and short only. We have different time frames, monthly, weekly, end of day, intraday, tick, high frequency trading. Have you heard about this? What is this?
Well, sometimes I know, but until but I don't know the words for
okay.
it. So when it's explained,
okay, I explain it. This is clear, right?
Yeah.
So here it's I look at monthly data. So I don't look every day. I look once per month, and I take all the data from one month, open, high, low, close, what's the highest, what's the lowest, what's the open, what's the close, and volume. And I base my trading decisions on this, and only once a month I'm trading. Here the same with a week, or here daily, or here intraday, let's say every 5 minutes, every 10 minutes. No? The point here is with tick, it's not minutes or hours or days.
It's really movement.
It's tick, exactly, each movement. Okay? And they are trading systems which are based on tick data. So they don't wait until 1 minute is finished, but they trade immediately. Okay? And this is called high frequency trading, especially in the United States. As I said at the beginning, a lot of volume is done by these high frequency traders. And you might have heard in 2010 there was this flash crash in May 2010 when the Dow plunged 1,000 points, and after 5 months of investigation the SEC found out that it was the reason was there was one big trade who wanted a fund who wanted to sell E-minis, S&P E-minis, in order to hedge his stock position, and this trade was big, and there was the high frequency traders who were adding to this big short trade, and they were sending the stock market 1,000 points down until trading was halted 5 seconds, and then it went up slowly again. Okay, so this is here to high frequency trading. Computers are so fast we can't react. We humans can't react. This is on one side an advantage. On the other side, it might be also a risk. But computers are faster than humans. Then systems can also differ in the kind of money or risk management, how much money they invest or how much risk they take. It's very important, especially when you trade futures, that you think on, that you have in mind the risk. How much risk am I willing to take, or how much money am I willing to lose by each trade? So this is very important when you enter a trade, that you know your risk, control your risk, and you control a lot. And then also, where are you investing? Okay, one security or a portfolio of securities. Most system traders, or let's say most systems, are based, or let's say optimized for one security. People say, well, this system works well at US dollar, euro. That works well in this currency, or works well on IBM, or works well on the treasury bond, whatever. It's highly recommended that your system should work, you should test it, and it should work on more than one security. And later when you trade it, you should trade your system on a portfolio. Also when you invest, you should never always invest in one security. You should always invest in a portfolio. That's rocket science. It's really basic mathematics. It's proven that if the more securities you invest in, the less risk you have, with the same outcome, with the same ROI, with the same profitability. So you always should not put everything in one basket, but diversify. It's really, really important. It's also here important in system trading. And the problem is, we as humans, we can't control maybe 100 stocks or 20 futures. It's too much for us. So there's an advantage in computers. Computers can do this. They can scan 10,000 stocks, and they can tell you at one day, these 10 stocks out of these 10,000 are interesting, and you invest in them. And the next day you sell them. And this is what computers can do. Humans can't do. That's a big advantage on systems. This is another way to what also systems can do. You have let's say a big portfolio. Let's say you have I don't know 100 stocks, but you always invest only in 5. You take 5, you pick 5 out of these 100, and the next day you change, you rotate to others. No, you always have 5 in your portfolio. You always invest in 5, 20%, 20%, 20%, 20%. So your investment is in 5 stocks, but these 5 stocks always change. You always take the 5 best stocks, for example. So it's stock picking. Yeah? So it's also a portfolio, but it's a fixed number of stocks, but the base is much bigger. Okay, and then you have different strategies. You have arbitrage trades, and you have trades which go long and short at the same time. Especially with options, you have a lot of variety. One of you has some experience with options?
Yes.
No. Because there are a lot of different strategies possible with options. Okay, good. What kind of systems do we have? But that's the most used one, trend following. No? We buy low and we sell high. We ride a trend. No? We have different indicators which help us identifying a trend. Most of you know the SMA breakout is also you have some highs and lows, and as soon as it breaks through the high, you go long, or as soon as it breaks through the low, you go short. Okay, so this is a trend following. A trend following system never buys at the lowest price and never sells at the highest price. A trend follower, because a trend following system first has to identify, is it a trend? And then it goes in. It takes the whole trend and then it waits until the trend ends. It rides the trend, but it never sells at the very high and it never buys at the very low. Okay? So as some examples for trend followers, I can show you, because I said here SMA crossover. No, I will show you later, sorry. Then there is also the difference, the counter trend. There's a theory that says, well, maybe sometimes there's too much pressure on a stock, it falls too strongly. So there's too much emotion in the market and the stock is oversold. I just buy good opportunities. It's a sale, I buy it at a very low price. And then the next day I sell it, because I hope there's a rebound. It's called a dip buyer or counter trend. Then you also have some others which are based on indicators. If the indicator, for example, the relative strength index, RSI, you might have heard of it, and some other indicators which identify a market situation and tell you buying or selling. Then you have arbitrage trades, which buy in one market, sell in another one. They look at divergences or opportunities, and then they buy at that moment. Swing traders are fast in and out trading, especially intradays. They try to they take advantage of the situations that usually movement is not going a strong line, but it's going like zigzag. So they believe that they can make they take advantage of these small movements. They go in and out, similar to these high frequency traders. And then you have a market maker. This is someone who believes that maybe if you have an idea that the security you're trading is not moving very much, then you can sell here and buy here. Sell here, buy here. You always offer here as a sell position, and you offer here as a long position. Short, long, short, long. And you always, because you believe that the stock always goes like this. If there are no news coming out, or if it's on holidays, some banks use these kind of systems which just offer a short and a long position, and they always make money, only small ticks, maybe 2 or 3 ticks, but over the long run, this also makes money. Then there's some very special, it's patterns. This is very, we can have a long discussion about this. Have you heard about Japanese candlesticks? Yeah? There are so many patterns, and people believe that if this pattern occurs, this is a long signal, or if this pattern occurs, it's a short signal. I did some tests with it some years ago, and I didn't find interesting patterns. But maybe some other people find it and are successful with it. I don't believe personally into this. Then of course we have this calendar base. Some news are coming out, and you believe that the market goes up or down, or if you don't know if the market goes up, you have a special system which, if the news comes out, it takes the news, analyzes it, and automatically buys according to the news which came out. This is a system which is acting autonomously, but depending on an external data on a news feed. The biggest news providers like Reuters and Thomson Financial, they have also news feeds, electronic news feeds, and computers read them and act upon the information which come out of this. Well, it's similar to it's event-based. It's more or less the same. Okay, then we have fundamentals. Of course, we have possibility to use a lot of data like dividends or earnings per share and all these information to use to, let's say, filter the group of stocks we want to invest in. We say we have 10,000 stocks and we only use the 100 best in earnings per share, for example. Good. Some examples. Have you heard of tunnel traders? These are the most typical trend followers. They were very first. In the 80s, they were very famous because there were two brothers. They were two friends, Richard Ennis and Bill Eckert. They had a dispute about if it's easy to trade or not, and then they trained 13 people to do simply trend following. If they realize the stock goes up, then continue buying, and they made a lot of profit just following the trend. We have to say, in the following 4 years, we have to say that the 80s were quite easy to make money because it always went up. Yeah, so all the stock markets, all the stocks went up, so it was quite easy to make money. Yeah? So at that time they said, well, anyone with average intelligence can learn to trade. Of course, if everything goes up, then it's easy to make money. It's like in the 90s, and all these the internet companies came out, and everybody made money just buying any internet stock, whatever it was, but everything went up. So that's not difficult in these kind of times. Also this year, well last year, sorry, 2013 was not difficult because everything went up. There was a lot of liquidity in the market and everybody bought stocks and so on. So it's difficult to make money when it goes sideways, when it goes down, when it goes down. Okay, some examples. Here what I said is a moving average crossover. We have here, you see here, this is a fast moving average and this is a slow moving average. Okay? And then there are systems which say, okay, if the fast moving average crosses from above to below, it's a sell signal. And when it crosses from below to above, it's a buy signal. You see, here we go short, and here we go long. From here to here, this is our game. And as all trend followers, we never buy at the bottom, and we never sell at the top. No, we always make the in-between, money in between. Okay, I can show you. I have a live example here. This is, you see here, this is software which I'm using to analyze, and you see here a small one and a fast one. And as you can see, here's the crossover, and then it buys here. You see? Here was a crossover and it sells here. Here's a crossover and it buys here. This is always the next day. Another nice example is a channel breakout. You have some channels here. These are the highest of 55 days. 55 days, the high. And if it breaks through the 55 days, I go long. No? Or if it breaks through the low of the 55 days, I go short. I can show you here.
That is total.
Sorry?
Total strategy. It's similar.
It's similar, yeah.
Yeah.
I don't remember if it was 55. Yeah, maybe. Well, all the trend followers are somehow breaking through something. So either the SMA or the highest. If this is turtle, I didn't know. I don't know what's the exact turtle strategy. Don't you tell us?
They're using 55 and they're using 20.
Okay, good. Thank you.
Very good. Education.
Very good. Okay, so what we also can do, that's what I did in one of my articles. I said, okay, why use 100? Why use 200? Why use 50? Why use 10? Huh? Why don't we use a variety of different SMAs? So I said, okay, we use different moving averages, okay, and we look at all of them. No, because here with this one is for short periods, and this one is for long periods. No? And then we can look at if there is a crossover from one to the next, or from one to all. You see, this example here it's from 10 to 100. No? So in 10 steps, we have different SMAs, and then we can create indicators based out of this. For example, if the price is above all, then the indicator is at 100. If it's below all, then the indicator is at 0. And if it's above some and above some others, then it's in between here. And we can build a system out of this indicator. Or we can here have the average percentage of distance of the price to the moving average, or we have the rate of raising, falling moving averages, and so on. I built different indicators, and you can play around with this unlimitedly. You know? It's just an example of what you can do with indicators, and you can use it then for systems and so on. Okay. Another example is now counter trend. Here we have this example of counter trend. Imagine this is our buy area. So we buy as soon as the price goes to this level. So we go buy here, we buy here, and we sell the next day. This level is 2.5% below the close of the day before. That's a very easy system. Just buy at 2.5% below the previous day close. And this is a line which indicates where I would buy. And sometimes I buy and sometimes I don't buy. But as you see, this trade is profitable, this trade is profitable. This is real data at Cisco. This trade is profitable. Here it buys, here it sells. Because similar to well, the normal fluctuations, it's not going in a straight line, it's always going like this. And there are always buying opportunities, like here, you know, buying, selling, buying, selling, buying, selling. No more buying. And here, for example, this of course is a disadvantage. This gap, the system doesn't get this gap, because the system is only buying in case of dips. Yeah? It buys only small, it only makes small amounts of gains. It doesn't make these kind of gains, it doesn't see it. But over the long run, and over many stocks, this can be profitable. Exactly. Because when I show you, here for example, this is a dip buyer, right here. On Yahoo you see many orders here. Our equity curve, this would be our equity curve for Yahoo. If we applied this system on Yahoo in 1 year. Okay? From 100,000 we invest, well, we always invest 100% of our equity into this trade. And then at the end we have 20% more. Here, this dark green means we are not invested, light green means we are invested. Okay, so you see these are the trades, so most of the time we are not invested in the system. Okay, we will come back to this system later when we talk about the portfolio. So here's another example of, here you can combine trend and counter trend. It's also an article I wrote. You have both in one. You have a combination. You have here the Donchian channels in order to define a trend. But if there's no trend, if you're in here and there's no trend signal, then you take advantage of these small variations and you just buy the dip. Okay, so both systems combined in one system. If you're interested, I can send you the article. I wrote an article about this. Okay, so this is the last example is indicator based. I talked before that we have several indicators like RSI, for example. Give a small variation. Here we have a small variation. Usually people say, well, the RSI, when it goes above, well, when it crosses from above 70 to below 70, then it's a sell signal, and when it crosses from below 30 to above 30, it's a buy signal. And then I was thinking, well, this also depends, this 30 and 70 rule, why has it to be fixed? Why don't we use some flexible bands here, the Bollinger bands, and we just use these flexible bands, because sometimes it might be here in this area and there are no signals at all. No? So let's keep this flexible, and so the system uses not the fixed 70 or 30, it uses these Bollinger bands as entry or exit rule. Okay, this is an example of an indicator. Okay, so this was an introduction. Now we start with the real stuff: how to develop a system. Okay, what do we have to have in mind? I will tell you in detail about these 5 steps what we have to have in mind. But here's let's say the overview. First, we have to have reliable and high quality data. We really need a good data source. So if the data is not good, we can't backtest. And if we can't backtest, or we don't have reliable information, reliable data, then our system won't work in real life. Okay, so we need good data source. We have to have first an idea which we think it makes sense, and then find a pattern out of this. For example, an idea could be there are certain situations in which the price goes down and that's not justified, like for a dip buyer. So I buy below the fair price, for example, or I buy very low because I believe most of the time that the price goes down, this is not justified. So that's my idea, and then I start to find the pattern. But first start with an idea, which is really would make sense in the market. Then you test the robustness of the pattern. Robustness means we want to see if it works at different time frames, at different markets, with different securities. If it works also if we change something in the rules and not only with this exact rule. And then we start trading. We start really trading with a small amount, either with a demo account or with a small amount. We test trade it. So we see if the system in which we believe is really working in real life. And if this works after maybe 3 or 4 months, then we start to trade it. But here, don't try to change the rules after, I don't know, 1 month or 2 months, or don't try to say, oh, now it's a different time, I don't want to follow my system, and then you maybe don't enter the market. As the girl which was sitting here said, real trading is different than demo trading. You should really follow your rules. If you believe your system, then you really should follow the rules. Okay, let's go into each of these points now in detail. Data source. Which market? We have to really, what I said, we have to think where do you want to invest. If you want to invest into a portfolio, you have to take into account that sometimes they are correlated. If you want to invest in stocks, and we say, okay, in order to minimize our risk, we just take the Dow 30, or let's say 100, Nasdaq 100, you have to take into account that these stocks are more or less all correlated. If the big stocks tank, the others also fall. No? So if you want to control your risk, don't invest everything in stocks. No? You have to be clear also about your broker, about what stocks your broker offers, or what kind of securities your broker offer, future and so on. You have to take then this data and you have to find it at a good data source. You have to find a good data source. In order to be sure that the data source is correct, usually it's best to take a second data source. So you compare the data. Otherwise you don't know if there are spikes, if the data is wrong, and so on. You have to really make sure that the quality of your data is good. This is something important. Many people forget it. With a dip buyer, for example, you buy low and you sell high. Okay? And what you do usually, today, 2014, what you say, okay, I invest in the Dow 30. You take stocks which are in the Dow 30, you take their data from 10 years ago, and you think, well, backtesting means 10 years ago, I would have started with these stocks and would have traded them until now. What is the error here? Who knows it?
Inflation.
Sorry?
Inflation.
Inflation is not the error. The error is index dropouts. There are many stocks which existed 10 years ago, which today they are not in the index. And many of these stocks which are now in the index, like Tesla, 10 years ago they didn't even exist. And I can't pretend that I traded them, that I started to trade these stocks which are now in the index 10 years ago, because 10 years ago I didn't know which stocks are in the index today. And the stocks in the index today are the winners. They're always the winners. And when you start 10 years ago, in your basket of 30 stocks, there are always losers. And you need to include these losers in your backtesting. If you don't do this, you fool yourself, because you always trade the winners. That's also why trading an index certificate is so successful, because indices are the portfolio of stocks which are always the winners. They always win. A bad stock is eliminated from an index. No? The Dow 30 or the Nasdaq 100 only has the 100 best or the 30 best stocks. The losers are falling out. Enron is not there anymore. But we would have traded Enron 10 years ago. So we have to have this in mind. And maybe we would have lost a lot of money. But the difficulty here is to get data for these stocks. You get data, back data, for the stocks of today. It's difficult to get data for stocks which disappeared from the market. And that's very time consuming, this kind of work, if you really want to make it correctly. Also, dividends. Stocks pay dividends. You don't see this in your data. Stock falls down, you don't know why it's going on. What is going on? It falls down because there are dividends. Usually the data is dividend adjusted, which means they take the data in the past and they move it downwards by the dividend which has been paid. But you have to know this, and you have to account for this in your backtesting. Another thing is, well, splits also. This should be the good data provider should take into account of this. High rising stocks usually split. If stock reaches 1,000, then they split it 1 to 10, and at the end it's 100. This split has to be taken into account. You have to think on this. Also, for futures, you have rollovers. Do you trade with futures? Yes, you trade with futures? No. Who trades with futures? You trade with futures. Future data. Usually do you use data yeah. You have usually continuous data, which takes one future. But the reality is not this. The reality is you have to make a rollover. And sometimes the spread is like this, and sometimes the spread is like this. And then the reality is that sometimes you have to pay a lot of points to make a rollover from one to the next, and the other, sometimes this is not the case. So the real backtesting would work if you say you take the real data, you take all the different future contracts, and you make a rollover yourself. But this is very time consuming also. Okay, this is one very important thing is never rely also only on one security, always trade a basket. I said it before, that you always should have a portfolio and not only trade on one stock or one future or one currency pair and so on. So second point, find a pattern based on an idea. You should have underlined it. First you have an idea, really. Don't just try to make number crunching and find some patterns and that's it. You really should have a reason to believe into this. There should be a reason, like what I said with dip buyer, or that you say during holidays, usually there's no trading and it's very flat, and I make a system which takes advantage of flat markets. No? Or when news comes out, then there's a lot of movement and I take care of this. These kind of things, that you have an idea before and then build a pattern out of it. Okay? Establish an idea that makes sense. And not just find something and then I have the holy grail and now I start trading. Then start to build a system on it with entry and exit signals, which means you have to know when to enter, when to exit, or what happens if you don't reach your limit, and so on. Make your system bulletproof, it's very important. Instead of optimizing, which is here, try to make it robust. Robust means it should work at different time frames, in different markets, different securities. Instead of trying to find the optimum parameter, try to see if when you change the parameter, if it still works. And if it still works, it's good. So in our example, for example, the different moving averages. Does it work only with 100 moving average, or does it also work with 90 or 110? If it works with 90 and 110, also, it's better than if it only works with 100. Because in the future, it might be that 90 is the optimum parameter. No? So it has to be robust. And what I said, always over and over, control your risk, really. The system should always control the risk. It should have a stop loss, each position size should have a maximum risk. Yeah? So you know, each trade, how much money you can lose. So when the system goes havoc, it goes weird. The maximum money we can lose is maybe 20% or 10% of our portfolio, whatever we define. Okay? Okay, and then I said simulate it on a portfolio instead of one stock. I show you now the difference between one stock and a portfolio. I showed you before the dip buyer, right? This is a dip buyer on Yahoo. You see, it makes 20%, it's nice. But here, no trading. and these dark green areas. If instead of trading it on one stock, we trade it on all 100 Nasdaq stocks, there's much more trading going on, because there's always every day a stock which fell at least 2.5%, and then we always have some stocks in our portfolio, and as you can see, these are the trades. You see there are many different stocks in our portfolio. No, we sell them again and we buy. Every day the system checks which stock is falling 2.5% and buying this stock accordingly. And the advantage is not only that we have more performance. What is the biggest advantage here compared to this?
Because it's steady rise and gives you
Yes.
confidence that your system
But
works.
yeah,
Exactly,
I can
exactly,
feel
exactly.
that something's going on.
You see how flat our portfolio equity curve is? It's very flat. And this is what we all should search for. We should all aim this kind of system. We don't want roller coaster. We want a steady increase. Every day a bit. That's what we're searching. Okay? And you can only get this if you trade many stocks at the same time, or many securities, or many futures, if you trade on a portfolio. It's very hard to get this if you only use it on one currency pair, or one stock. And in order to trade 100 or 1,000 stocks, you need computers. Yeah, you need systems. But here it's where systems help you. You see, they flatten your equity curve. Yeah? And that's really an important thing. I show you now. Wait. You see, well, I have it here again. I have some stocks here. These are 6 stocks: Apple, Amazon, Cisco, Microsoft, Tesla, and Yahoo. You see, these are the results for these different stocks. Some are great here, yeah? but we don't want this. We don't want this, because this is like a roller coaster. Yeah? We want a steady curve. We want this. Yeah? That's what I showed you. Yeah. That's what we want. Okay. Yeah, more or less with some dips, but this is much better than trading only on one. So please have it in mind. Always try to simulate and later on also trade your system on a portfolio. Never only on one security. And you need a software for this. And very few software tools help you in this. Yeah? And that's something I learned at the very beginning, that's a very important point in order to flatten your equity curve, that you have to trade on a portfolio. And it's not okay if you say, well, I had a trader who told me, well, I can trade on the QQQ, it's an index. No, but the index is only one security. You need many securities. And the less they are correlated, the better. So try to find securities which are not correlated. So stocks and futures and currencies and maybe options if you try. But try to really find different securities which are not correlated to each other in order to flatten your curve. So don't search for the high profit. Search for low risk. So this is flatten the equity curve. Okay. Good. Third point is we need to make our system robust. What I said already, we have to change markets, portfolios, time frames, different money management settings. If it still works under different market conditions and different settings, yeah, then it's a good system. Also check the data. If we buy, for example, people they like to buy stocks which are traded at $1 or $2. Be careful, because if these stocks, if there's low volume, maybe you simulate that you buy 100,000 stocks, and there's not enough volume on these kind of stocks. Also futures. No? Sometimes the price has a very low volume. So check this. Or if you touch the price, for example, you have a high-low, and you believe that you can sell at the high, or you can buy at the low of the day, please be very careful. Most of the times, you are not the first, you are the last person to get something at this or this price. I also had a lot of experience with this. My orders were never filled. I saw the price there, and I had a limit at this price, and I didn't get it. And I even called the exchange. I said, what's going on? And I was always at the end of the order queue. Don't believe that you get the high or the low of the day. Slippage is it's an expression which is said when you have orders, and for example you have you say you buy it open, at the open of the day, but sometimes at the open of the day, let's say it's 110, and you get it for 111. You said, hey, the open is 110, yeah, but you were filled at 110, and the part of your order went to 112, and at the end you got it for 111. So sometimes your order is not executed at the price which the data source says, but some other price. So there's some slippage. You're slipping away. Always use commission in your simulation. Commission is very important, especially when you do a lot of trades, like dip buyer, for example. You need really a broker with low commission. And this is something for advanced users. Monte Carlo simulations is, once you have your system and you tested all this, then do a Monte Carlo simulation. What Monte Carlo simulation is doing is, it takes, let's say, the 10 years and scrambles the years. Let's say it puts 5 years at the beginning and then the other 5 years at the end. And then it runs the system. If it still works like this, or it changes the years, or it changes some other stuff. It does a lot of changes in the data source. And if it still works, your system, then it's really a robust system. But you see, what I'm saying is, contrary to what many people do, they try to find the optimum parameters and the optimum markets and the optimum securities and the optimum time frames where the system works best. And that's not what we should search for. We should search for a system which is more a general system, which works at many, many different time frames, many parameters, many securities, and so on. Yeah, because then it's robust. Because times are changing. The past will never repeat itself. Never. So what happened in the past, what worked in the past, will never work in the future. Except if it's very robust. It has to be very robust. Okay, then fourth point, we do a demo account, we start trading. We are ready with our simulation, and we start trading. We can trade with a demo account, or we can trade with a small amount of money. But we really have to follow each trade, and we have to do it various months to see if we can do it, if we can follow it, and if our system works well. Because what happens many times is that as soon as you start trading, either you can't do it personally because it's too many, or you have different, it's too fast, or too many trades, or maybe the system doesn't work anymore because you realize you have optimized it to the past, and now the future is different than the past, and now our performance goes down. I will come back to this point later. Then also, when you trade, watch your trades to your simulated results, to your backtested results. Are they the same? Or are you getting different fills or worse fills? Are you getting a lot of slippage? You have to really think of this. Because if this is the case, then you might recalculate your backtesting. And of course, what I said always, don't change the rules while trading, because then the test isn't a real test. So the test has to be with the same rules as the simulation. If you change the rules, then you have to do it all again. You have to simulate it and then trade it again with new rules. Okay. Good. And if you're ready, if you're happy with it, then you can start trading. Believe in your system. Trade every day, no exceptions, no changing of rules, and learn during your trading. This is a theory. If you follow these steps, at least you control your risk and your system is stable. What not to do? How not to develop a system? I said it already. testing only on one security or one market. If you optimize too much, instead of optimizing, try to generalize. No risk control, no slippage, etc. All these things we already were talking about here. What I said before, the test trading, this here, is very important so you can distinguish from what you simulated, backtesting, to real trading. And what happens often is you trade, you simulate, sorry, and then you start trading and the performance like this. Yeah? Or even worse, you have here, that's a real system, which with data from 91 to 2001. And it's perfect system. We start trading, and the same system is doing this performance. It's the same system. It was optimized on 10 years of data, and then it was started trading on data which the system didn't know before. It was out of sample data, and suddenly the system doesn't work anymore. What we are searching for is this. Yeah? We optimize it here, or we develop it here, and then it continues to trade more or less in the same manner. That's what we are searching for. In order to find this, really we have to, what I said here, we have to first test it, trade test it on out of sample data. Out of sample means it's data we never knew existed when we did the back testing, when we did the simulations. What comes here into my mind is the following. Have you heard about this? Who has heard about forward optimization? No, it's very technical. Imagine you have a parameter like this moving average, 100, no? Moving average 100. You say, well, in the past, it worked best with a parameter of 90. And now I'm trading, and now I realize it works best with parameter of 100. And then I trade another month, and I realize it works best with a parameter of 110, because maybe the markets are changing. Okay, so there's a theory which says, well, we do a walk-forward optimization. We say we trade, we optimize it, the best parameter for 4 months, then we trade 1 month with this parameter we found here, and then we do another optimization for the last 4 months. We find another parameter and we trade with this parameter on this month, and so on and so forth. So we always have a small out of sample data, and then we use it for our optimization. And again, and again, and again. This is more or less what we would do if we do a system development, we trade it. System development, we trade it, and so on. This is very common at system developers, because they say that with this they eliminate this out of sample, in sample problem. You know this problem here? In sample, out of sample. They say, well, we optimize it here, then we trade one month, and then we use this data and optimize it again. We trade 1 month, and so on. In the theory, it sounds okay, but if you develop a system which is doing this, all the data you use, it's already in sample. I would say this is in sample data, it's not out of sample data. Because your system is trained to know this. You know? It's not real demo trading as you are doing, or test trading. It's a simulation using this data, so there's nothing new in it. So I'm not a fan of this. I would say, no, this is not correct. We are using here in-sample data, not out-of-sample data. Okay, maybe this was a bit too technical, but this is more or less the series, and what do you have to have in mind when you develop a system. of course, each of these points is getting more, there are many, many details, and it takes hours and days and weeks and months to get all this set. But I want to have a final word about optimization. This, I took it from a website, and it's really, I wanted to read this. This is a website which is trading thousands or hundreds of thousands of systems, testing hundreds of thousands of systems at the same time. And it's trying to, not to optimize the system, but to look at what kind of parameters have to be changed in order to make a system more robust. And what they came out of is that non-profit related variables, like what I said, the number of days without a new equity high, these kind of variables are more helping to make a system robust than looking at profits, for example, no? at rate of return. I can really recommend you to have a look at this website. There are very interesting articles at this website. They are really analyzing systems and markets and so on. So that's more or less the bottom line to what I told you. Control your risk, try to minimize your drawdown, try to minimize the number of days without a new equity high, try to flatten your curve. This is more important than improving your gains, your profits, no? Or the maximum, the high, and so on. Try to be conservative, and this is really, it's not, let's say, guarantee for success, but it's at least 50% for success. So, this was, let's say, introduction in what you have to have in mind when to build a system. But if this is so much work for you and you really don't want to mess up, you can also, there's an alternative. You can buy or rent a system. There are many people who are offering their systems to you. You can rent it on a monthly basis, you can buy it. No? And there are also websites which offer these kind of systems. I show you a small website. Oops. It's a website where people can, system developers, they can present their systems here, okay? And then you can choose them, and you can here $300 per month, and you can get every month the signals, every day the signals, and you can choose to trade them yourself, or you can even connect to a broker, and the signals are sent automatically to a broker. And the trades automatically are done, so you don't have to do anything. You just have to pay this per month. Okay, so they have here all kind of systems, forex systems, and you see here the look at the equity curve. It's quite flat. Well, maybe not this one, but this one here. Really, they're great systems.
Any recommendation?
From my point of view, recommending none. I will give you my last slide is disclaimer. There's no recommendation whatsoever what to buy, what to do.
No, because now I receive a lot of emails from the States.
Yes.
Because at some point I was doing internet business and they sell so much for the systems that you pay X and they do.
Exactly. I will
And I
tell you
will
now
pass that.
what you have to have in mind. You see, they do
But
all
I
the way.
believe is that you just give them the money and they do it for you.
Also, no, here not here. Here,
Ah,
here this website doesn't get your money. You have a broker where you have your money, and they give
They do
you
it for you.
and they give you the signals, and you give the broker the authorization that they can trade your money, but they can't take money out of your account. They don't have access to your account except trading. They can only trade. Okay, they can trade your.
But I believe there are other systems that they do everything for you.
They are doing everything for you. But this is not a broker. Collective 2 is just a website.
Yeah.
It's not a broker. But they have auto trading somewhere here. I have to see.
Auto trade?
Yes, auto trade. And then you can connect to your broker. They work with different brokers. I don't know which brokers it is, but you have to open an account. You have to open an account at a broker, and I don't know. Let's see which brokers they support. And then you, which brokers here? Here, are there. Well, also interactive brokers, yeah, that's fine. So these brokers, it works with them. So they connect directly to this broker and then they send this signals to this broker. And you don't have to do anything. You just pay every month this fee. Okay? I just, before you now jump to the website and order one of these systems, I want you to be careful about this. Because these systems, they don't look so bad, they look quite well. What we usually look at, we look at the equity curve, okay? We look at the equity curve here. We want a flat equity curve. We don't want this. This is, well, we don't want this easy, yeah? But these kind of systems here, this is a great system, isn't it? It's a great system? You agree, don't you? I would say it is a great system until now, but let's have a look first. What would you like to look at the system before we decide to buy it? First, we want to be sure that it's real trading. The results are real trading. And at this website, which I showed you, the results are real trading. It's not backtesting. Second, we want a smooth equity curve. That's what we just said. We look at the maximum drawdown. No? What is the maximum we lose? What is the maximum of days without a new equity high? Of course, what is the ROI? What's the profit? What kind of markets are they invested? And what kind of commission is used? All this is, they use commission at a collective tool. They tell you what kind of market it is. So these kind of things, they're very transparent at collective tool. You can see everything. But now I have a question to you. These are two systems from collective tool. I will now show you this one and this one. I put them on one side. They're here and here, okay? These two systems. I show you now my slide so you can decide. Which one do you think is better? I ask you. Give me the top one. Why? You said? No? Don't know? Another opinion maybe?
Well, if you said it has to be smooth, I would say the bottom one.
This has less drawdown, right? It's smoother because look here from here, if 600,000 to here, well this is with commission and this without commission, okay? From here to here, well it doesn't matter, it's 200,000 drawdown, it's 30% of drawdown. We don't have this here. We have here this drawdown, we have here a bit, but we have no drawdown here.
But the top system is going over a year, so the drawdown would be even not only big, it will also very long. It's from 2011.
From here to here, no?
Yeah, it's almost a year.
It's over a year.
Underneath it's just a few months.
Yeah, what do you want to tell me with this?
I don't know, that's very, I mean, the length of the drawdown, I think you compare here, not apples with pears, but the one that goes over like 5 months and the other one goes over years.
Yes, exactly.
So actually, if I would look into the other one, then...
actually, these two systems, although they are called differently, they are from the same system developer. And the system developer, what he did, because here his system looked very bad, he just created a new system on this website with the same logic.
Okay.
So this system is the same system as this.
Starting a different day.
Yes. So imagine this. This looks much better. But of course, we only have here 1 year of trading. Yeah? And now if we go back to our website here and look at the systems, I ordered them, I made an order by time, by age, because I want to see the old systems. I don't want to see a system which is 5 months old. I want to see a system which is 10 years old. Look now. Okay, this is okay, but look, still, the drawdown here at this extreme. Look what the performance of the system is. These systems are 6, 7 years old. Would you trade these systems? I would not. And having this in mind, these people still have their systems here, and it costs them money. The developers who have these systems have to pay a fee every month. Most of developers who have systems who are losing money take their system out of the website. So most of loser systems are not shown here anymore. It's the same as with the index, the Dow 30, what I told you. Losers are falling out of the system, out of the index. The same happens here. Losing systems usually don't appear here. That these systems appear here is really a coincidence. It's really thanks to the developers that the developer left the system here on the side, but usually what the developers do is they remove them. So you see, the long-running systems, they don't have good performance. The good ones, they do, but the long one, they don't do. So what does it tell us? It tells us that these systems, sooner or later, they don't work anymore. They might work maybe 1 year or 2 years, maximum. But we don't know if it's 1 year or maybe 6 months. And you don't know when it stops. So be really careful by all these system developers. Because they are really brains, but they never know what happens in the future. They're really good, but they don't know what happens in the future. So that's what I said. Look here, you can go to the website, you have here this system finder, and you say, okay, I make a sort by age, and this is the oldest system, you know, these are bars. You see how they go down. And still this one here, this Extreme OS, where is it? This one. Still this. I'm not sure if I would trade it, because look how roller coaster this is. It's a roller coaster system. Here you have. Look at this drawdown here. Here from here. Well, this is August 5. Well, July 29 until. July 29, 2011.
So what you're looking for is like a really smooth upward curve of a really
Absolutely.
long period of time, and it doesn't exist.
It's 2 years. 2 years of waiting until you get to the point where you had your last high. You have to wait 2 years here. Who waits 2 years trading every day? You're here, you're losing money, you trade every day. That's crazy.
But there were only few trades when the curve goes down. So it's it's a short period of time they was made.
Yeah.
Those trades.
Exactly. Imagine how
It's like
frustrated you are.
huge drawdown.
Imagine, you know, here, you were here, okay? This was middle of 2010. And then 2012 you say, oh, 1.5 year for nothing. 1.5 year trading for nothing. No. That's so frustrating.
And you already made this amazing.
Yes, we're here,
amazing
and you lost it.
upgrade,
And then, you know, you knock your head against the wall.
Yeah.
And you still pay a lot of money for the system every month. No, you pay a lot of money. How much is it? Where is it?
Yeah, it's the money you paid, and also it's like it's some capital. You know, your capital is sitting there doing nothing for you.
Exactly. So be really careful when you analyze systems and try to buy a system. Okay, that's really my suggestion.
There's always this nice quote from I think Mark Twain that forecasts are very difficult, specifically if they concern the future.
That's very good. I like this. It's bottom line. I like this.
You lost a lot of money.
Yeah, he did. He said something. The best trading months is June, August, January, March, December. No,
All 12 months.
exactly.
Okay, I just want to end with an interesting approach of a colleague of mine who is developing systems, and he also has some systems here on this website. And his approach is a bit different, okay? But he uses computers also. And it starts with an investment base of 1,000 stocks. it takes 1,000 stocks. It's the 1,000 most liquid stocks in the US market. Okay? It has maximum of 60 positions at the same time. We as a person, we can't check this, but at least we have a big portfolio. There's a lot of risk. The risk is really spread among many securities. He has a filter which includes certain stocks based on fundamental data, good stocks, and he has an exclude filter which excludes stocks which fundamentally are not good. Okay, and then it's a typical dip buyer. It buys because there are some indicators and because it waits for a long for a deep price, so in order to catch a cheap price, and then to sell in after 1 week or with a certain profit target. Okay, similar to the dip buyers I showed you already, but it uses this filter before because it has some fundamental sound data. So it takes good stocks which are fundamentally good and says, okay, if these stocks fall, then we believe that it's irrational. Okay, and on top it uses 1,000 stocks. It uses a huge amount of stocks, not only 30 Dow or 100 Dow stocks. Okay, and he's right now participating in a contest because there are different contests. Funds, mutual funds are doing contests so in order to identify good traders, best systems, and so on. And please don't be surprised, but this is the equity curve, but only backtested. It's only backtesting. We have to see how it works out because right now he's trading it in real time. Next time I can update you how the real-time trading is going on. But I like the approach because the approach is not only we have one system on one security based only on data, on price and volume, but also on fundamental data, and we use from a big list of stocks. We use some of the best. We use the best stocks and we trade on them. Okay. Yeah, you can look at his website finantic.de. He's working with funds and tries to invest their money in the system. Okay, good. This is the final word. I don't expect that this is now the result also in real trading. We have to see it, but I like the approach. I think it's an interesting approach not to only use the system mechanically, but also use some external data to do some filtering. Okay, good. I have to have a final word. There's no recommendation whatsoever about what system to buy, what to do, and not to do. This is not a recommendation to buy anything because it's very risky. Okay, and that's why I have this disclaimer here. I can send you also the PowerPoint if you want. And if you have more questions, you can also phone me anytime or send me an email. I have a small website, but I didn't update it for many years, so we can see what I did there. Okay? Good. Okay.
Extremely interesting. We went really out of time, but it's 8 o'clock already. So what we can do, as it was longer than expected.
Oh, sorry.
No problem. Is that if anyone has some questions for Jose, we can